Hey everybody, hope everyone is doing well and had a good day. And in this video, I will review the 5-minute chart for the Emini for Monday, August 4th, 2025. Very quickly, I want to talk about the daily chart. We've been in a bull trend. We had a possible final flag, although at the time I remember thinking, I'm not sure if this was enough selling pressure, but possibly was a final flag where we have a bull trend, range expansion, range compression, kind of a triangle shape, not perfect, and then we got the bull breakout, so tight trading range, late in a bull trend, possible final flag, meaning the next breakout fails to go very far before the market comes back and tests the apex of this triangle. The triangle is an area of agreement. Trading ranges, where there's sideways price action, these are areas of agreement. And most breakouts of trading ranges fail. And when it occurs late in a trend, it's a possible final bull flag where we get the breakout, the market reverses back down and tests somewhere in this range. We tested lower than the apex of the range, so the purple line would have been the middle, but we actually tested the support from July 16th. And broke maybe slightly below. Let me turn on the snap mode. We currently have a possible double bottom bull flag, but we did break slightly below the July low. We also got strong reversal and follow through. Look at the pullback section, so there's less gaps. We can see basically it's the same picture with less gaps. So you have the strong breakout, possible final flag, bull breakout, a couple of legs up, reversal back down into the range, and then a possible double bottom bull flag. But the market broke slightly below that low, and this was a major higher low. This broke out strongly to a new high in the bull trend. So once the market falls below a major higher low like this, it's now either in a trading range or a bear trend, most likely. Trading range, more likely. Probably have to go more sideways before reversing into a major trend reversal. This was a really strong bull trend, and the bears only have a couple of big bars here on the daily chart now, but the selling pressure through here, not very good. But you can see the market tested the support and found buyers, and this was simply a sell vacuum testing support before we found buyers and a sharp reversal up. So this is probably the bottom of a trading range. The reversal and follow through is strong enough for a second leg. There are trapped traders above, so the upside here might be limited. And now we have big up, big down, big up. So it seems like the market is transitioning into a trading range. I apologize for the background noise. Going into the day, if we look at the day-only chart, it's not perfect, but Friday was a contracting triangle, which is breakout mode. You could say the market was in a bear trend. We had a lot of bars trending below the moving average, gap down, more bear breakout, but eventually this bull micro channel did enough to end the bear trend. At that point, it's probably a trading range or an opposite trend. And that's what happened. The market was in a trading range. So the bulls got their second leg, but it's a lower high. The bears break out to a new low, testing the lows, but fail to go far. You can see the breakout below, but there's enough sideways here that if this is a broad bear channel with lower highs and lower lows, it's broad enough that it's basically a trading range that's sloped, and breakout direction becomes close to 50-50. And if you remember where we are on the daily chart, we might be at support. But let's assume it's 50-50 and we just wait for the breakout. We have a gap up going into the day, gapping up far above many bars to the left, and then follow through buying on bar 1. Very strong bull breakout bar. The market accepted the gap up, so we rallied, or we gapped up. Let's look at the Globex session really quickly. Here's the 15-minute chart. Here's the information going into the day. So back here's the close of last week, last Friday, and then the market rallied in this tight channel and really continued in this tight spike and channel trend. So we're bullish going into the day from the Globex chart. Always in long, bull market regime. But if we just looked at the 5-minute RTH breakout mode, gap up, follow through buying, possible bull trend from the open. I don't have time to do a bar by bar, but I do want to talk about a few things with the little time that I have today. First thing, let's talk about the rally bars 1 through 7. Breakout mode, gap up, follow through, and more follow through buying. If you rank or judge the strength of this breakout with the 10+2 strength factors, you know it's probably getting a high score. You have a lot of bars closing on their highs, closing above the highs of the prior bar, uniform size bars through here, nothing very climactic, small tails, micro gaps, no opposite bars. I mean, it just about has everything going for it. You know this is probably a bull leg in a trend, which means traditionally if we use the wide stop below bar 1, you buy anywhere. Let's say you bought the high tick. Probability is that if you buy, use a wide stop, and especially if you're willing to scale in, you're probably going to make money. The market's probably going to test the highs before there's a major reversal. V tops and V bottoms are rare, and most breakouts get second legs, especially a strong one like this. So bar 7, weak reversal bar, and bar 8 triggered the sell below bar 7. But let's think about what happened. Once there's finally a pullback, so finally a bar goes below the low of the prior bar. So once there's a pullback, we've entered either a channel phase, which results in trend resumption for the bulls, or it's a trend reversal. For the bears, the trend reversal argument is weak. It's low probability. Strong bull leg, second leg likely. The first time the bears get a bar like this, yes, it's a bear trend bar, and it looks relatively strong, but it's small, or it's average in size, and it's only breaking out below the prior bar, not even below bar 6. So we have a bear breakout breaking below a trading range bar, but the bar is not very big compared to the rest of the bars. It's not a very significant bear breakout. It's probably minor. Bulls will actually buy that bar because if you think about the trader's equation for bar 8, let's say a bear sells the close of 8, stop above 7, and they have good risk-reward. The risk-reward ratio is fantastic. Stop above 7, sell the close, you could make maybe 3 or 4 R going for a test of the bar 1 low. But you know, if you have fantastic risk-reward, that you must have low probability, because there must be a reason for a trader to take the opposite side of a trade. Also, if you can see a low probability trade, you're also looking at a high probability trade because everything has an opposite. So the bears have relatively small risk relative to the big reward, and that means they have low probability. You know, based on typical market behavior, if you study charts and breakouts and second legs, most of the time the bulls will get a second leg before there's any major reversal. In theory, the stop goes below 1 for the bulls, but in this case, if it's probably a bull leg, you can probably put your stop at or just below the 50% pullback level, so bulls might buy the close of 8, stop here, betting that their initial risk is bigger than their actual risk will be, and they can make a scalp to a new high. Because remember, at this point, the market is either reversing or it's the start of a channel phase, and the bulls will get trend resumption, and you expect the trend resumption to be weaker than the breakout phase. The breakout phase is the stronger part of the trend, but the channel phase still grinds up to new highs. The problem is in the channel phase, bulls are going to take profits at new highs. So if you take the buy, bar 8, your profit target is a new high where the bear's tight stop is, and you're probably going to make money, but your risk-reward ratio is bad. Your stop is far, and the reward is relatively small, but you have high probability, so that's what makes it a positive trader's equation. So you can buy the close of 8 or sell the close of 8, and with proper management, you have a positive trader's equation depending on your personality. Basically, if you're a trader that wants small risk and big reward, and you're okay with losing most of the time, or if you like high probability and scalping, then you can take the opposite side of it and you can buy. And the trade worked quickly for the bulls. Reversal, we fell below bar 6, reversed up, went to a new high above 7, and found profit taking. But now 10 is another weak sell setup. Right now at this point, the market's probably in a bull trend, and it's either a small pullback trend or it's becoming a spike and channel bull trend. When this is the case, if it's a small pullback trend, what I've found is you want to take profits at new highs, because in the channel phase, bulls take profits at the highs and then they look to buy pullbacks. So the only problem with that is if you're taking profits at new highs and you're an active trader and you're aggressive, you're going to be quick to re-enter. So now 10 is similar to bar 7. It's a weak sell setup. It's a double top, but it's a weak trading range reversal bar for the signal. You know the risk reward is good, which means the probability is low. So if you're looking to buy and take the higher probability side of the trade, you can buy. Again, use a wide stop. Stop below 9 is a skunk stop. 9 is not a major high or low. So if you're buying, your stop is not below 9. I think at a minimum, it's below the midpoint here. And in theory, it's really below bar 1, but a trader's never going to let that stop get hit. It's just a protective stop that invalidates your premise. So bar 10 is another bar that you can buy below, buy the close, but again, you're just scalping at a new high. And that trade again worked quickly. Now possibly 3 pushes up, 1, 2, 3, and at a new high, so probably going to find profit taking. But again, you can be quick to re-enter, so probably buyers below 13, buyers below 14, scaling and lower, probably buyers in the buy zone of 9. Remember, stop below 9 is a skunk stop, and I suspect there are buyers in the buy zone of 9, so the midpoint down. So 15 might be a buy the closed bar, and 16 went outside up to a new high. Problem with 16 now with buying is that bulls are taking profits. We're again at a new high at the top of the channel. So bulls will take profits at new highs or on the close of 16. Bears will sell for scalps, but in this kind of situation, small pullback trending behavior, it's easier to make money buying. So for me, I'd rather just take the buys and profits at new highs rather than looking to sell to go short at the new highs. I just patiently wait for the pullbacks. 16 is another buy signal bar. Even though it went to a new high, it's a buy in the buy zone of the bar, buy the midpoint or buy below the bar, buy the close of 15, and pretty much rinse and repeat. Now the only thing that changed here, look at the buy below 7, or if you bought the close 8, or bought below 6, you're in the trade for 2 to 3 bars, and it's a quick trade. If you bought the close or bought below 10, you're in the trade for 2 bars, and you're out. You bought the close 15, you bought the buy zone of 9, you're out of the trade in 1 bar. It's different over here. If you bought the close 17, you're in the trade for 1, 2, 3, 4 bars. You're still not on a new high. Now you have maybe 1, 2, 3, maybe 4 pushes up, head and shoulders top. It's still probably a minor. This is all probably a pullback or a channel in a bull trend. But even the microstructure here, 1, 2, 3 pushes, there is an option to take an early exit on the close of 20 or 21 because we didn't get to a new high and we're losing momentum going sideways. And you can see, like I said, the difference in the time in the trade over here for 1 or 2 bars versus here. It's different. And the market pulled back for a couple of more legs. 22 probably needs a second piece down. This is a low 2 for the bears, very minor, probably going below 26. Might test the moving average, but overall it's still a bull trend, and you should be looking to buy, not sell. 27 probably a buy the close bar. First touch of the moving average and a strong bull trend with a sideways pullback. This might be a sideways high 3. And the last leg, 1, 2, 3, subdivided into 2 pushes down. 27, not a great buy signal. You can wait for a better buy signal bar, but some traders will buy above 27 for a trade looking for a new high, take profits at a new high. 28 is a better signal bar, good entry bar. You could buy the close, scale in, press the trade. 30, break out to a new high, but it's strong, so maybe there's profit taking here, but this needs a second piece. You can buy the close 30 and scale in. You can buy the close 31, buy below 31, buy below 33. There's reasons to buy. Stop goes below 27. Expecting, if it's still a bull trend, your premise, then we should not fall below 27. So you can buy at really anywhere, stop below 27 and look for a scalp to a new high. Maybe getting a second leg down. 38, a buy signal. Sideways, high 2. It's kind of similar to this. Strong bull breakout, sideways pullback, then breakout to a new high. Strong bull breakout, sideways pullback. Maybe we'll get a breakout to a new high. Maybe the bears need one more push and another test of the moving average, but the downside here is probably limited because it's a bull regime. The breakout strong, micro gap, uniform size bars, sideways pullback, selling pressure is weak. There's maybe a high 3 for the bulls, and then there's the breakout to the new high. And I really can't go much longer here. That's pretty much going to be it for the review. This is kind of a small spike in channel that evolved into a trading range, but we still stayed above this major higher low, so the bull trend is still intact. It's a channel. We're getting higher highs and higher lows. If you draw a best fit line for the highs and then draw a parallel, it gives you a possible best fit trend line, and you can see the reaction to it there. It's not perfect, but you can always adjust it, and it works pretty well. So that's going to be it for today's review. Thanks everybody for watching and listening, and I hope everyone has a good night.